Hello ECO152 students, welcome to the first session of week 11. During this session, we will cover the effects, causes as well as an anti-inflation policy. We will concentrate on section 10.3 until 10.5 from chapter 10 of Understanding Macroeconomics, which is our prescribed textbook. At the end of this session, you should be able to do the following. Firstly, explain the distribution, economic, social, and political effects of inflation. Secondly, describe the causes of inflation. Thirdly, explain demand pull and cost push inflation. And lastly, describe policies that can be used to combat inflation. The effects of inflation are not obvious and immediately identified, yet they trouble everyone. So who is exactly hurt by inflation? To understand this question, let us look at the following three sets of inflation effects, namely distributional effects, economic effects, as well as social and political effects. Generally, inflation benefits borrowers or debtors at the expense of lenders or creditors. This is so simply because inflation erodes the real value or purchasing power of money. To understand this, let us consider a simple example. Suppose in 2010 you borrowed your cousin 5,000 Rand with no interest. In 2020, due to the COVID-19 pandemic, your finances suffers greatly and your cousin returned your 5,000 Rand. Suppose from 2010 up until 2020, inflation has risen by 33%. Therefore, in nominal terms, you did receive your 5,000 Rand in 2020. However, in the real terms, you have received 3,759.40. In short, your cousin has benefited simply because the basket of goods and services he could purchase with 5,000 Rand in 2010, you could not afford it now in 2020, but only a basket equivalent to 3,759.40. Thus, the purchasing power of the 5,000 Rand is decreased over time. More so, we can also see that your cousin benefited further since the nominal interest rate, in this case it was 0, was less than the inflation rate, which is 33%. In this scenario, you have been disadvantaged twice, as firstly, the real value of your wealth has declined, and secondly, the interest was not sufficient enough to cover inflation or the loss of your purchasing power. The younger generation and the government tends to gain more from inflation at the expense of the elderly and the private sector, respectively. On the other hand, the government can benefit from inflation due to a phenomenon called bracket creep, which happens when inflation is combined with a progressive income tax system. Although the distributional effects of inflation are unplanned, they do not affect the overall performance of the economy. Inflation economically affect the level of employment and growth negatively. However, this could have been avoided. For instance, inflation diverts firms' strategies from innovation and risk-taking towards anticipating inflation as well as speculative activities, which do not add any value to the economic production. More so, due to the decrease in purchasing power, inflation can discourage savings. Furthermore, inflation may lead to balance of payments problems due to the loss of international competitiveness as well as an increase in cost of exports and import competing industries. Generally, inflation creates dissatisfaction amongst different social groups, leading to social and political unrest. In most cases, persistent inflation makes it difficult for firms and households to budget effectively. As a result, it creates a climate of uncertainty and even hopelessness. More so, since people expect prices of goods and services to increase in the future, they also start to make plans of their salaries and purchases, incorporating inflation expectations, which will eventually lead to inflation. This process becomes self-fulfilling prophecy. Therefore, the quicker the cycle of expected inflation takes place, the more inflation increases. If this process is not controlled effectively, hyperinflation will occur. See box 10.2 for a discussion of hyperinflation. The inflation process is complex and dynamic, hence it cannot be ascribed to a single cause. Let us discuss some features that trigger the inflation process by looking at demand pull inflation and cost push inflation. However, to fully understand this complex intertwined phenomena, we need to investigate the mechanisms of price changes in the economy over time. Demand pull inflation happens when aggregate demand for goods and services increases whilst aggregate supply remains the same. The excess demand increases or pulls up prices of goods and services. The demand pull inflation is caused by a combination and or any of the various elements of aggregate demand. It has a positive impact on gross domestic product and employment, given that there exist unemployed resources in the economy. However, to combat it, restrictive monetary and fiscal policies can be implemented. Whilst restrictive policies can resolve demand pull inflation, they tend to decrease production, income, and employment levels. The graph shows demand pull inflation. Suppose initially the economy is at E1 with the total production or income of Y1, then the government decides to increase government expenditure twice to E3. The increase in government expenditure will cause aggregate demand curve to shift to E2 and eventually E3, provided there exist unutilized resources. Prices, total production, income, and employment increases as the economy transitions from E1 to E3. However, after reaching full employment output, further increases in aggregate demand only leads to inflation with no improvement or change in total production, income, and employment. To combat demand pull inflation, a restrictive policy can be implemented which will shift the aggregate demand curve from E4 to E2, thereby reducing inflation as well as total production, income, and employment. Cost push inflation occurs when the cost of production increases. Thus, increases in production cost push up the prices. There are 5 main sources of cost push inflation, namely increases in wages and salaries, increases in the cost of importing capital and intermediate goods, increases in profit margins, as well as a decrease in productivity and natural disasters. Cost push inflation has both total output and employment, resulting in a phenomenon called stagflation, that is, inflation accompanied with low total output and unemployment. To combat cost push inflation, measures has to be taken to avoid increases in the cost of production. That is, increases in the remuneration needs to be kept in control and productivity per labor needs to be increased. Restrictive monetary and fiscal policies cannot be used to address cost push inflation, as they can succeed in reducing unemployment but cause an even greater increase in prices or inflation. The figure illustrates cost push inflation. Suppose initially the economy is characterized by total output Y1, prices P1, and an equilibrium equal to E1. Due to the ongoing Rhodes food strike, let us assume that the management of Rhodes Foods decided to improve working conditions, pay for overtime, or increase the wages and salaries of their workers. All of these actions will lead to an increase in the cost of production, causing the aggregate supply curve to shift upwards or to the left to AS2. As a result of these changes, the economy is now at a new equilibrium, E2, with the total output of Y2 and the prices of P2. Therefore, the increase in the cost of production has led to stagflation, that is, inflation accompanied by low production and unemployment. South Africa became the 15th country to adopt formal inflation targeting as its monetary policy framework in February in the year 2000. Inflation targeting is an anti-inflationary policy in which the South African Reserve Bank maintains the inflation rate within the targeted range of 3 to 6%. This policy framework has 5 key elements. Firstly, the announcement of a quantitative target. That is, the Reserve Bank has to make decision of whether they should use a point or a range, or which index are they going to use to target, or over which time frame are they going to achieve their target. Secondly, the acceptance by government officials that the main objective of monetary policy is price stability, together with the central bank operational independence. Thirdly, the adoption of a wide range of variables to help in assisting the decision-making process when appropriately setting the policy instrument. Fourthly, transparency. And lastly, accountability. The inflation targeting framework has several advantages and a few disadvantages. Since its adoption, the South African Reserve Bank had gained credibility over its operations, as they, faced with various economic shocks, maintain price stability at all costs. However, inflation fighting requires the cooperation of all stakeholders in the economy.